Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Monday, everybody. I hope you had a restful weekend, and I wish you all a productive week ahead. We begin, as we usually do, with the economy. Late last week, China published terrible trade data, with imports declining, a sign of chronically weak demand. We covered this a few days ago. CPI data, published over the weekend, reinforced this grim picture. Saturday's inflation data showed CPI was up a less than expected 0.3% year-on-year in October, and down 0.3% month-on-month. The first time it has been down on a month-on-month basis since June. This doesn't at all suggest strong domestic demand relative to supply. PPI inflation also disappointed, having declined 2.9% year-on-year in October. Several China analysts pointed out that China is headed for a very negative GDP deflator again this year. It is hoped that the 10 trillion yuan, $1.4 trillion stimulus package announced on Friday evening, which we covered in Saturday's video, will help mitigate this deflationary spiral. The same day also saw new official numbers around debt. According to the data, China's macro leverage ratio continued to rise and hit a new record in the third quarter. The ratio grew 2.5 percentage points to reach 298.1%. In total, the ratio grew by just over 10 percentage points in the first 9 months of the year. Some analysts believe China's total debt is much higher, however, with some estimates as high as 350 to 400% of GDP. Household debt declined by 0.3 percentage points of GDP in the third quarter, shrinking for 2 consecutive quarters. As historically household debt was driven by purchasing homes, this isn't surprising to see. Next up for the economy, in recent days, Premier Li was at the China International Import Expo. China launched the CIIE in 2018 at the beginning of its trade war with the US in a bid to convince global partners of Beijing's commitment to free trade and expanding access to its market. He used his speech at the event to reiterate the same script Beijing has been using since the end of Zero COVID, so far to limited success, that the PRC economic fundamentals are sound and that they are on track for the 2024 growth target, and the PRC offers a massive market opportunity to other countries as it further opens its markets. In an apparent reference to the escalating tensions with the EU and US over electric vehicle tariffs, Li also complained of acts of dishonesty and rule-breaking, adding, quote, "Many issues that should not have been a problem keep emerging," end quote. He added that officials had, quote, "ample space for fiscal policy and monetary policy," end quote, and reiterated that China would hit its economic growth target of around 5%. Now, this brings us nicely to our last development on the economic front. In response to a speech from General Secretary Xi Jinping to senior officials at the Central Party School, China's foremost ideological trading center, last week, where he instructed cadres at all levels to do their utmost to reach annual economic targets, Chinese localities are redoubling their efforts to meet annual targets for economic growth in the final quarter of the year, calling on officials to accelerate investment, enhance consumption, and increase foreign trade as the window of opportunity begins to narrow. In response to this news, our old friend, Professor of Finance at Peking University, Michael Pettis, made several points. Quote, "It's almost as if they believe the slowdown in growth this year has been caused by official forgetfulness rather than by structural problems. But insisting that local governments meet growth targets at all costs also means that local governments do the very things that in the past caused the structural imbalances, the surge in non-productive investment, and soaring debt that Beijing has been trying to address. China was always able to meet its GDP growth targets easily as long as local officials had debt capacity and were indifferent to the quality and sustainability of the growth. Because they no longer have debt capacity, they must shift borrowing to the central government. But Beijing should be protecting central government debt capacity. It will need it to avoid social and economic disruptions once the economy begins the very difficult process of raising the consumption share of GDP. It is worth remembering that Japan's consumption share of GDP bottomed out in 1991, and it took 17 years, to 2008, to raise it by 10 percentage points, and China has to raise it by much more than 10 percentage points. During that period, however, Japan's central government debt rose from 39% of GDP to 138% of GDP. This is why the sooner China begins the difficult rebalancing process, and the cleaner the central government balance sheet, the better for China in the medium and long term. Rebalancing almost certainly requires slower growth as China more aggressively limits non-productive investment. If Beijing is absolutely determined to meet the 5% growth target, it will do so, but expect to see a surge in central government debt and a more difficult economic adjustment once it finally decides, or is forced, to adjust. End quote. Next up, we continue our ongoing coverage with how China and the world is reacting to the US presidential election and a second Trump White House. But first, we move into today's sponsored content. Sponsored content is restricted to just 1 or 2 per month. This is to ensure that the channel is financially sustainable while still primarily supported by subscribers. If you'd like to know how I work with sponsors, this is in the description below. Let's discuss a company that offers strong potential exposure to gold. Let's reveal the value proposition of Gold Mining Inc., trading on the New York Stock Exchange under the ticker symbol GLDG, which is the sponsor of today's video. Gold Mining Inc. is trading for 86 US cents right now, which is near its 5-year low. This is a very important part of the reason of showcasing this right now. Spot gold is trading at an all-time high. Gold stocks, ETFs like the GDXJ and the GDXU are trading near 52-week highs, yet Gold Mining Inc. is still near its 5-year low. There has never been a better time to build a position in gold companies than in November 2024. The gold spot price is $2,698 per ounce, over 40% above the 2011 all-time high. Yet the DGXJ index is down 66% compared with its peak from 2011. As you know, Bank of America predicts gold could hit $3,000 by the end of 2025. So let's talk about Gold Mining Inc.'s near-term catalysts. The company owns 80% of an Alaskan gold exploration and development company, US Gold Mining Inc. It's a position that is currently worth around $80 million based on the closing price of US Gold Mining stock. That company is in the middle of a drill program right now. The company owns an approximately $30 million position in Gold Royalty Corp., one of the fastest growing royalty companies in the natural reserve sector. Gold Mining Inc. owns 75% of a uranium project that gets almost zero attention, even though the founder of the company and its present co-chairman is Mr. Amir Adnani, the founder of Uranium Energy Corp., a multi-billion-dollar uranium company. The project is located in the Athabasca Basin in Alberta, Canada, one of the best uranium areas around the globe, and it is co-owned with French uranium giant Orano. When the company originally acquired their dozen gold projects, the peak combined market caps of the companies that held them was approximately 850 million Canadian dollars, which during the peak of 2010 through 2012 was much closer to par with the USD than today. The combined market cap was calculated based on each respective company's peak share during the period prior to acquisition. While past performance may not be indicative of future performance, and these are just small windows where GLDG appreciated, it could show that Gold Mining Inc. has previously performed well at times when we were in a rising gold price environment. This is a strong value proposition. Gold Mining Inc. owns a total of 11 projects containing an estimated 12.5 million ounces of gold equivalent resources in the measured and indicated category, and an additional estimated 9.7 million ounces of gold equivalent resources in the inferred category. With a market cap currently at $175 million and approximately 120 million in publicly traded stock in its coffers based on current market values, how much is the market ascribing to gold mining assets? That question is the value proposition being shared here. Moreover, a shareholder of Gold Mining Inc. at today's price is getting GLDG at its 5-year lows and indirectly enjoys exposure to GROY and USGO near their own all-time lows, right before the Federal Reserve rate-cutting policy is slated to begin. Like many resource companies, this is a moderate-risk, high-reward speculative opportunity for investors looking for that kind of play in their portfolio and is worth looking into. As always, make sure you do your own research and review Gold Mining's public filings, which are available on EDGAR, EDGAR. We remember that all investment involves risk. This sponsored content is not individual investment advice. Always do your own due diligence and speak to an investment professional before making any major investment decision. A big thank you to Gold Mining Inc. for sponsoring this episode of China Update. We now return to regular coverage. In a special piece published today, UK-based The Financial Times, citing several unnamed sources, reports that Taiwan is considering buying a big package of US weapons, including the Aegis destroyer, quote, to show the incoming administration of Donald Trump that it is serious about boosting its own defense against China, end quote. According to the outlet, Taipei would probably request the Lockheed Martin vessels and Northrop Grumman's E-2D Advanced Hawkeye, an airborne radar system. It also wants more Patriot missiles and may request F-35 fighter jets, which would be controversial in Washington. One former Trump administration official reportedly told the outlet, quote, "Taiwan is thinking about a package to show that they are serious. Assuming they follow through, they will go to the U.S. National Security Advisor when they are named and present a very aggressive package of American hardware." End quote. A senior Taiwanese national security official said there had been, quote, "informal discussions," end quote, with the Trump team about what kind of arms package would demonstrate Taiwan's determination to invest in its own defense, reportedly expressing, quote, "There are quite a few big platforms and other items that our armed forces have had their eye on for a long time, but have not been able to acquire, so there's a lot to choose from," end quote. A Taiwanese official told the outlet that Aegis would be near top of the list, but officials and defense experts said there were other more expensive items Taiwan needs that would leave a bigger impression. People familiar with the discussions, the outlet writes, said Taiwan could request as many as 60 F-35 fighters, 4 advanced Hawkeyes, 10 retired warships, and 400 Patriot missiles, a package that is estimated to be worth more than $15 billion. Some Taiwanese officials told the outlet that concerns about the risk of a second Trump administration were overblown, with one expressing, quote, "There is strong bipartisan backing for Taiwan, as you can see from the steady flow of legislation and resolutions aimed at bolstering support for Taiwan. The first Trump administration oversaw more frequent and higher-level visits, and it unblocked arms sales to our country," end quote. During Trump's first term, the U.S. approved 11 packages to Taiwan worth $21 billion, including F-16 fighter jets and Abrams tanks. The Biden administration approved deals worth $7 billion. Meanwhile, in light of President-elect Donald Trump's commitment to curbing Chinese imports through potentially steep tariffs, China has been considering a range of strategies to counteract the economic fallout. Trump's proposal, which included tariffs as high as 60% on Chinese goods, directly challenges the economic model championed by Xi Jinping, which focuses on industrial growth and exports as key drivers of economic stability. In response, Chinese leaders have been exploring various methods to strengthen relations with U.S. allies in Europe and Asia by offering trade incentives, such as reduced tariffs and visa exemptions, to offset the potential economic impact of losing U.S. market access. Over the weekend, in an excellent long piece, the U.S.-based Wall Street Journal explored just this. Beijing's strategy to win over America's allies is multi-faced, aiming to buy time and leverage in a shifting global power dynamic. China's approach, referred to as unilateral opening, represents a departure from the traditionally reciprocal deals that have characterized its economic diplomacy. By making one-sided concessions, China hopes to attract new trade partners and investment without requiring immediate reciprocal actions from these countries. The strategy could potentially help China mitigate some of the adverse effects of Trump's trade policies. Despite these overtures, Beijing's efforts to attract European countries and key Asian allies face significant challenges. As regular viewers know all too well, relations between China and the European Union have grown more strained, in part due to China's support for Russia amid the conflict in Ukraine, which Europe views as a significant security threat. Additionally, U.S. allies in Asia, such as Japan, South Korea, and the Philippines, have become increasingly cautious about China's rising influence and assertive policies. Indeed, survey data of both popular and elite views in many of these countries shows that China is very unpopular currently. As a sign of its new approach, China has already waived visa requirements for citizens of around 2 dozen countries, including Australia, New Zealand, Denmark, Finland, and South Korea. Furthermore, in recent meetings, Xi Jinping's top economic advisor, He Feng, hinted at potential tariff reductions in specific sectors, particularly those like telecommunications equipment, electrical goods, and agricultural products. The evolving Chinese strategy reflects the uncertainty Beijing anticipates with Trump's administration. Trump's initial term fundamentally shifted U.S.-China relations, moving from a policy of engagement to a more confrontational stance. Some analysts would argue, though, that China was already in a confrontational stance and that the U.S. simply caught up. China sees an opportunity to leverage Trump's return to office as a way to create further divisions between the U.S. and its allies. Chinese leaders perceive Trump's leadership style as unpredictable, and they believe this approach might hasten what they view as an eventual decline of U.S. global dominance, creating more domestic and international friction that could benefit China in re-establishing ties with European and other international partners. It is unclear whether Beijing is accurate in this outlook, however. U.S. strategists anticipate that Trump's tariff policies, if enacted, may hinge on China's adherence to the Phase 1 trade deal, an agreement aimed at increasing Chinese purchases of U.S. goods signed between the first Trump administration and Beijing. Larry Hu, China economist at Macquarie, estimated that a 60% tariff increase by the US could reduce China's economic growth by 2 percentage points in the 12 months following the implementation. He explained in a recent note, quote, "Trade War 2.0 could end China's ongoing growth model, in which exports and manufacturing have been the main growth driver." End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Monday, have a productive week, and I will see you all tomorrow.